Your market news now. Emerging market stocks rose for a fourth straight session and were on track for their second quarterly gain in a row as fears of a banking crisis gradually faded away and focus shifted to key inflation data from the US and the Eurozone. Focus later in the day will shift to the dollar as data is expected to show that US consumer prices, excluding volatile food and fuel prices, remained unchanged in February from a month ago. The rand firmed against the dollar, extending gains after the South African Reserve Bank raised its main interest rate by higher than forecast 50 basis points to 7.75% in a surprise move. To talk to us about the week that was and, of course, unpack a lot that is playing out in the markets right now, we are joined by Warwick Lucas from Galileo Securities. Warwick, thank you so much for your time. Your read in terms of how the markets are adjusting to that surprise move that we saw out of the SARB yesterday.
Yeah, I think initially I was surprised, but perhaps it shouldn't be. I think firstly because we've got power cuts from Eskom, there's obviously a supply side problem. What that means is that retailers have to use their own private generators for the whole food cold chain, and that's expensive. So what tends to happen then is you get retailers hiking their prices to recover costs. And this is an example of what you call stagflation. I've got to say also that PPI was quite a fearful number this month. That came out yesterday, 12.2. And that's a manufacturer's inflation number. So it's very noisy, but it's also a bit of an uncomfortable indicator. And then also we had a high wage settlement from the state, that's 7.5%. I mean, no one in the private sector is getting 7.5%. And again, I think the Reserve Bank would have had their eye on that and said, oh dear, we just got to keep an eye on that. And I think all of that sort of would actually justifiably lead to this 50 basis point hike.
On that note then, because depending on which commentary you were digesting from the beginning of the week, a lot of the economists were expecting 25 basis points rather. So were you surprised at all that the Reserve Bank went for 50 basis points? And I suppose the second part to my question, to what extent do you believe that was meant to protect the currency?
Well, I think it's always a bit of graduation in these meetings. I mean, they take a whole lot of subjective data, some objective data, and then they say, well, 25 basis points or 50. So there's always going to be an issue of degrees. How far do you take it? I think by going 50 basis points, I think the general hope and the general sentiment perhaps out there is that they might have given themselves a high point for this rate hiking cycle. I think certainly many consumers and borrowers, for that matter, will be fervently hoping that this is indeed the end of the cycle. It certainly looks like it should be enough for the cycle, but there's always new news and unexpected unknowns that can change matters.
Let's discuss things from an equity side of the market. Are there nodes of stress that could put pressure on equities in this environment?
Well, they're always out of there. Look, I mean, it's been a curious environment in that the expected US recession, which of course is an example of risk on, it's the most expected recession ever, and it still hasn't materialized. And indeed, notwithstanding frequent discussion about it, if one looks at the Atlanta Fed GDP now data, it's very robust. It still expects quite decent GDP growth out of the States. So what can put nodes of pressure on markets? Well, that's surprises, and there's lots of them out there. More bank runs, although I think that's been stabilized, supply chain issues and arising or in spite of deglobalization, sticky inflation, wherever it can arises. I mean, the Fed has shown that it has no fear of inflation and that it will do what's necessary to fight inflation. But at the same time, they also haven't just gone and said, oh, well, we're running negative rates, let's just jack them up some more. I think they do appreciate that you can run negative rates, but because it's been such a low interest rate environment, the cash flows needed to fund a debt are actually much larger than would have been budgeted for. But I think at the same time, that also means that you're going to have a long cycle before the global inflation really gets under control. I think perhaps the most important thing throughout this whole inflation cycle, perhaps locally and abroad, it's very important that the residential real estate market keeps its footing after some fashion.
Let's stay with things on the United States front. When you look at the performance of the NASDAQ versus the Dow, at least over the past few months, since the beginning of the year, rather, what do you make of that move that we're seeing on the NASDAQ?
Okay, so it's actually been quite a remarkable run. I mean, we've seen the NASDAQ actually up 12% from the beginning of the year, well ahead of the Dow, which has drifted slightly off in that time. I think maybe some of that will relate to company prospects, but quite a lot of other issues will be what's happened in the long bond markets in the US that I'm referring to, because those rates dictate quite a lot how shares tend to be priced. And what we can see is that short-dated bonds have generally not been that kind to value type equities and so on, whereas long bonds will have been very supportive to the kind of shares that make up the big caps in NASDAQ. So some of it's a technical argument, some of it will be pure bounce, i.e. what is the company doing? Does it look like it's going to pull itself towards itself? And I think perhaps a general hope that certainly in relation to the big techs that the worst intermediate news anyway is out of the way.
Warwick, let's leave it there. Thank you so much for your time. That is Warwick Lucas from Galileo Securities. Of course, the big risk on event that we are going to be paying attention to is next week Friday's U.S. jobs report figure. If the figure does come in higher than expected, that would mean that the Fed does have at least more impetus to at least want to deal with what's happening on the inflation front, provided that we don't see anything else break on the banking side. And if it does come in a little bit lower, then it might give markets some confidence to believe that the Fed might be inclined to pause. However, that is it from me. We're going to take a quick break. When we come back, we'll have SME on point with Jabo Seto. Stay tuned.